You can save $1,400 per year, whether it is good for you to buy a property with fixed or variable mortgage. On 17th of September, we are predicting 50-50 chance that we might get a 25 bips cut in the prime lending rate. You can save $1,400 per year if you go for a variable mortgage. Hello everyone, welcome to our channel. In this video, we'll talk about the most important date, that is 17th of September, when Bank of Canada is coming again for a rate cut news. If it happens to be 0.25 cut, how it's going to impact your cash flow, whether it is good for you to buy a property with fixed or variable mortgage, and we'll give you a live example of a $1 million property, how it's going to save you $1,400 every year with 0.25 cut. We'll go into pros and cons of getting a fixed and variable mortgages. We'll talk about all the penalties and future scenario which is better for you, fixed or variable mortgage. First of all, let's try to understand where we are right now. On 17th of September 2005, we are predicting 50-50 chance that we might get a 25 bips cut in the prime lending rate, which is 4.95 now. So how it's going to impact everyone's cash flow? Imagine you purchase a property and you go for fixed mortgage. In that case, your rate of interest is locked. You don't have any choice for the entire frame and the entire tenure to get into a variable mortgage. Most of the people in Canada, they go for generally 3-year or 5-year fixed mortgage. So you can renegotiate your rate only after 3 years with the bank. Some banks give you a flexibility of 2.5 years before, 6 months before the rate is getting renewed. You can start negotiating your price. So this is the fixed scenario. But if you go for a variable mortgages, variable are two types. Basically, as the name indicate, one is variable itself where the payments are fixed, but more goes towards your interest if the rate goes up and down. Basically, if the rate is going up, for example, on 17th of September, Bank of Canada pushes the prime rate up by 0.25. In that case, your payments will go up. This is a variable and you'll be contributing more towards your interest rate. There's adjustable variable where the payments adjust monthly with the rate changes. For true variability, this means every month your payment will increase or decrease based on the variable mortgages. Instead of that's adjustable, if it would have been variable, that would have been better for you because you are not paying extra. Your monthly cash flow is the same. No doubt your interest component might increase. We have seen scenarios of people where the amortization have went negative for the people. Let's say they have to, or instead of paying the mortgage in 30 years, it went to 35 years because they were on variable. So that is a scenario for fixed and variable. That's basically, now it's a very important decision for your life whether you should go for fixed or a variable. Let's try to understand the importance of fixed. Fixed means you need a peace of mind. You have predictable payments that are going, so you are protected against any rate hike that is happening in the future. So that's more of a low risk person where fixed is better. But there's obviously a disadvantage to getting fixed because you have penalties to break. That's very important. In case you sell your property after 2 years and you have a 3-year mortgages which you took initially, now you have to pay more penalty when you go for fixed mortgages, and you obviously miss on rate drops if that happens on 17th of September. Now let's try to understand if you go for variable mortgages, which I always prefer for all my properties, and we educate the same to the clients also. In the variable mortgages, your payment will fluctuate based on the prime lending rate. You have a benefit of rate cuts. That's a big edge for you. You have a flexibility reason. If you want to sell that property out, you have only 3 months of interest payments as the penalty. And most important thing is you can transfer to variable to fix any time without paying any penalty. Let's say in the future, after 2 years, you felt that the economy is recovering and we might see more interest rate hikes happening in the future. It is better to go for fixed mortgages at that time and you don't have to pay that penalty, which is not available when you're going for a fixed mortgages. But obviously there's a disadvantage because payments are always volatile. There's more risk factor involved. If on 17th of September a bank rate goes up by 0.25, your payments will also fluctuate based on that. Better to go for variable mortgages rather than adjustable variable where your payments will fluctuate every time. So at least you have a better cash flow. That was about fixed and variable. Now let's take an example of fixed mortgages. Imagine you buy a property of $1 million with a 20% down, which is better for you as of now. With the variable rate is around 4.24. With the variable rate, your payment is coming around $3,900. But imagine you are going for a fix and you got a very good deal from a bank for a let's say 3-year fix. You got a 3.99. Your payment will be around $3,800. This means you're saving approximately $114 per month. That's a very good news for you. But imagine in the future, which you are predicting that Bank of Canada is meeting 3 times this year, if you are getting at least minimum 2 cuts and 4.9424 rate that we are having, and it goes to let's say 3.79, this is a clear winner. Now your fixed will still remain on 3.99, but your variable payment have went to $3,700. So this is how you save money when you go for a variable mortgages. And considering the current scenario, based on Bank of Canada news, based on Bank of America news, and based on what basically Great Britain have done, they have already reduced their rates recently. So we are predicting we will get more rate cut coming in the future. And considering the GDP growth, considering the unemployment rate, considering all the economic scenarios, the prediction is the rates going down rather than going up. So that's where the people, it's better for you to go for variable. And in the future, let's say 2027, the prices are starting going up, you can always move back to the fixed mortgage for the remainder of the tenure. And also you need to understand one more concept here is when you are going for mortgages, initial component goes more towards your interest rather than towards your principal. So this green part is your principal and this is your interest part. Overall, in 5-year tenure, most of the component that will be paid is your interest compared to your principal. So there's another thing you need to consider when you're going for fixed or variable. What is a prepayment privilege is given to you. This means how much amount that you can pay irrespective of your monthly payments or semi-monthly you are giving towards your mortgage. So if you have any $100 or $500 or $1,000 saved on the side, you can directly pay towards your principal, which will reduce your principal and reduce your amortization. Next time when you refinance it, your interest payments will reduce. So that's always recommended that you talk to the bank where even you're getting fixed or variable, what type of prepayment privileges are given. Generally, banks give you a 20% prepayment privilege for that anniversary year, for a whole year. So this means if you have $1 million mortgage, 20% is $200,000 you can pay without paying any penalty towards your principal. That'll help you reduce your amortization schedule. Now let's talk about what is a future prediction, whether you should go for fixed or variable. As we already talked about, based on what economists are saying, we might get another 2 cuts this year. So if you go variable now, but lock if tariff spikes inflation. This means if they are saying any more inflations coming up, you can call, depends on your risk appetite, you can always switch to variable mortgages. I think we are almost done. So basically we try to cover the scenarios of fixed and variable mortgages. I think that's a very important discussion that you need to have. It's more of a one-to-one conversation that you need to make with your financial advisor, with your mortgage agent, or with your power team. It might be your real estate agent who are doing so many deals day to day and they know what people are going for, and based on their experience they can guide you, and then from there you can make an educated decision, fixed or variable. Recently, based on our experience, 90% of the deal that we are doing, people are going for variable mortgages considering the market scenario. And obviously it's a market, it's a seasonal thing, it will change, so our prediction will change in the future, but as of now it is better to go for variable. Last thing I just want to mention here is we do regular mastermind events at our office. It's a more of a one-to-one conversation, more of a group education that is happening, because if you are educated, then only you can make wise and meaningful decision for your bright future, because real estate is one of the biggest investment for your life. So do attend our events. I'll share the description of those events. Now share your thoughts. What is better? Are you going for fixed or variable? And also don't forget to subscribe and like to our channel. Thank you for watching this video.